gold could drop $1,000 an ounce, and it would still be at an absolutely fantastic level for the business of mining this stuff. We're exploring with this building. Like, we're down $1,000 an ounce now from 5,600 to 4,600. Maybe come back up a little bit this afternoon. But 4,600, are you kidding me? These mines were built considering prices under 2,000. If $5,600 gold was actually pricing in all this other stuff that I think still will drive it higher, if I'm wrong, if I'm overestimating, how much damage that does and underestimating how high gold has responded to that, the long-term average allocation to gold globally is 2%. And recently it's only been half. So you don't need to have everybody filling their bunkers in Idaho with gold bars and silver bars and stuff like that. If it just reverts to mean, if it just goes back to what was normal, that would quadruple the investment demand for gold.
According to mining expert Lobo Tiggre, even a $1,000 drop in gold prices would leave the sector in outstanding shape. With gold pulling back from $5,600 to around $4,600 per ounce, mining economics remain highly profitable, as most mines were built assuming prices below $2,000. Tiggre notes that fears of downside risk are overstated compared to the massive upside potential driven by global allocation shifts. Historically, gold represents about 2% of global portfolios, yet recent levels are closer to 1%. A simple reversion to the mean would quadruple investment demand without panic buying or extreme behavior, supporting much higher long-term prices. Now, we present the clips from Lobo Tiggre interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
If $5,600 gold was actually pricing in all this other stuff that I think still will drive it higher, if I'm wrong, if I'm overestimating, how much damage that does and underestimating how high gold has responded to that, then this could be it. That could be the top. But I don't think it's for that reason. Now, it's interesting that you frame it that way, though, because I do think, you've talked to Rick Rule, I'm sure, about how the long-term average allocation to gold globally is 2%. And recently it's only been half. So you don't need to have everybody filling their bunkers in Idaho with gold bars and silver bars and stuff like that. If it just reverts to mean, if it just goes back to what was normal, that would quadruple the investment demand for gold. I think there's evidence that that's happened. I don't know that it'll go back to the previous mean, but you know what? If it just went back to 1%, that would double the investment. And I can't prove this, but anecdotally, it just seems like here, deep pocket. Famous people like Gundlach and Dalio and others have talked about gold. Gundlach famously saying 25%, not 2%.
Morgan Stanley
would not be excessive, and then he dialed it back to just 10, right? And Morgan Stanley, the instead of 60-40, the 60-20-20, like there has been a game changer here, and it's not just the central bank buying; it's institutional money, it's deep-pocketed money, it's old European money. There are big pools of cash out there that have said, you know what, some allocation to gold is reasonable, whereas it was like crickets before, and I don't see that changing. I certainly don't see the wrong Kevin changing. If the metals are continuing to fall, I don't expect great earnings to outweigh that. The good news is that if the metals fall and the stocks just get whacked, never mind the woodshed, they get blown out of the water completely, right? If that happens at the same time that they're making more money, your value proposition is improving. So the difference between price and value is the essence of what Casey taught me as a basis for speculation. So I don't want this to happen. I'm just saying that if it does, whether I want it to or not, that can be a source of opportunity. But I think it's naive to think, oh yeah, they're going to have blowout earnings. My company with its blowout earnings, it's going to be spared the bloodbath. No, nobody gets spared the bloodbath. If we see another $500 drop a day in gold, your most stellar performer is still going to get whacked. Let's say we ping around between 47 and 5,000 all year, up and down all year. That would actually be a fantastic price for the actual business of mining the stuff. Right. The feasibility studies for the developers, they wouldn't assume that price. It would be assuming lower prices for exploration. You have none of it, so then, like Rick Rule again says, if you have no gold, it doesn't matter what the price of gold is. But in a price environment like that, what you're exploring is so valuable that people will fund your work. So the reality is something like what you're describing would be fantastic for the actual companies, what they're doing on the ground. And to the degree that investors investors get disgruntled, disappointed, or, oh, this isn't 5,000, I'm taking my marbles and going home, or, right? To the degree that happens, that is an option in my opinion.
Okay.
The only way that's a mistake is if we get, let's say, if this week was the peak in September of 2011, gold kind of fooled along volatile for a year, and then it really fell off a cliff in 2012. So if that's in front of us and you start buying and accumulating over the next year, and then there's a cliff in a year, then you'll get hurt. So, I don't think that's where we are. Again, I do not think that, and I do expect to be buying this year on the volatility.
Even if $5,600 gold marked a temporary peak, the broader case for gold remains intact. Veteran investors point out that global gold allocation historically averaged 2%, yet recently hovered near 1% or less. A simple return to normal levels would double or even quadruple investment demand without widespread panic buying. Influential voices like Rick Rule, Jeff Gundlach, and Ray Dalio have openly supported higher gold allocations, signaling a structural shift among institutional and deep-pocketed investors. Volatility, including sharp pullbacks, does not undermine the value proposition for mining companies whose feasibility studies assume far lower prices. As Doug Casey taught, the gap between price and value creates opportunity, especially when strong businesses are temporarily discounted by market fear. Let's get back to the
I don't have a whole lot of conviction on the broader markets, but I will say that in my career, in this career, since I started with Doug Casey 20 whatever years ago, I don't even want to think how many years ago it was, every year, gold bugs and hard money tend to be suspicious of the mainstream economy. Every year there's people saying the market's going to crash, the economy's going into recession, maybe we should sell our stocks and buy after the crash. That would have been the smart thing to do in 2008 and in 2020. Every other year in my entire career, that would have been a mistake. So you say, what's the math say? And I'm telling you, the math, whatever your own personal view might be, the math says you have a 1 in 10 chance maybe. If there is a bona fide market crash, a 2008 or 2020 type event, that gold will get whacked, the stocks will get whacked, everything gets whacked at that, but they come screaming back after. And here's the thing: if the reaction is the initial liquidity drive puts these things on sale. And as soon as that liquidity is met and cleaned up, they go screaming back again. Then gold goes screaming back. Everybody will know that the miners will make huge amounts of money, right? So at a time where you got economic weakness and people are not sure whether the Mag 7 are going to recover or what's going to happen, the one thing that will be sure is that those miners, and here's where that reporting that we've been talking about, the earnings that we've been talking about will come in. The earnings, everybody else's earnings will be in question, but not the miner. And the mid-tiers become a takeover, and the juniors also become assimilated, because if you're not discovering, you have to acquire. So it supports the whole sector. It trickles down. It takes time to do that. But what I'm saying is there's a scenario here where the broader markets and economy goes into a tailspin, and that very thing drives safe haven demand, the monetary metals higher, which actually keeps the fire under the boiler for the miners and related equity. If you can substitute copper for silver, $6 a pound is nothing like $80 an ounce. So if you can substitute it, you will. I don't know many ladies who would be very happy these days with a copper mirror. Though 10,000 years ago, that was a great thing. So there's a lot of stuff that's just not good. It's silver's reflectivity. There's something chemical.
Like our military, like our drones there's some things that are just.
You want the best you can get you're not going to substitute. On the other hand, if you've got, let's say, a copper version of a solar panel that's, let's say, 10% less efficient, both 10% less efficient versus a tenth the cost, that starts to, make sense all of a sudden. So we could, and that is a huge use case. So we could see, actually, I think, significant substitution. But on the other
hand, if they're looking to build
new uses, like remember when photography, the big scare with photography, we're going to digital photography. We're not going to need any silver anymore. It's the end of silver, but everybody's going digital on photography. And guess what? It turned out the gadgets, they use more silver than the film ever did. So, yeah, I'm not persuaded by these bear cases for silver. If you really want a bear case for silver related to this, it's not copper substitution. It's that the demand for copper gets so big, prices rise so high, that high prices cure high prices, and a bunch of huge mega projects come online. And as everybody knows, silver is mostly produced as a byproduct, and copper is the single biggest. So combined lead and zinc are bigger than copper, but on a single metal basis, big copper mines are the world's largest supply of silver. So if we're going to have, bunches and bunches of these major copper mines come online that will increase the supply of silver. And if the demand of silver doesn't keep up with that, then that could be a bearish scenario. But that's going to take years. Like if that happens,
We're not close to
we're
it.
talking 5-10 years down the road, maybe.
Veteran resource investors argue that betting on constant market crashes is historically a mistake. Outside of rare events like 2008 or 2020, selling equities in anticipation of a downturn has usually underperformed. Even in a true liquidity-driven crash, gold, silver, and mining stocks may fall briefly, but they tend to rebound faster and stronger. Safe haven demand and rising monetary metal prices can reinforce miners' earnings when broader corporate profits are uncertain. Mid-tier miners become acquisition targets, while juniors are absorbed to replace declining reserves. Bearish arguments for silver, including copper substitution, remain unconvincing in the near term. Structural demand, unique physical properties, and constrained supply dynamics continue to support precious metals over the long run. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.